If you have been watching the news coming out of our neighbor Indonesia, or if you are an investor with exposure to ASEAN infrastructure plays, you have almost certainly seen the scary headlines regarding the Whoosh high-speed rail. The narrative is everywhere, and it is terrifyingly simple. The headline numbers are screaming about a $7.3 billion US price tag. You are reading stories about a China debt trap, about a project that is bleeding cash, and about a sovereign nation potentially losing control of its strategic assets. It sounds like a disaster waiting to happen. And if you hold regional banking stocks or infrastructure conglomerates in your portfolio, your first instinct might be to sell. But if you strip away the political noise and the terrifying one-liners, the real story is actually quite different. The real decline here isn't about Chinese predatory lending. It is a much more subtle and frankly much more dangerous issue for investors called governance risk. If you look at the actual data, the operational reality versus the financial reality tells a story that isn't about geopolitics, but about execution. And that is a far more complex problem that affects how we value everything from Indonesian consumer staples to Singaporean banks with regional loan books. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work to make sure we get this right. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls before the mainstream news catches up. Today, we are going to do exactly that with a deep dive, point-by-point analysis through the Whoosh project and why it is a massive lesson for your governance checklist. Let's start our methodical breakdown by looking at the asset itself. We need to separate the physical reality from the financial balance sheet. First, let's look at the operational side. In October 2023, the Jakarta-Bandung Whoosh launched. If you look at it purely as a piece of engineering, it is an undeniable success. It cuts travel time between these two major economic hubs from a grueling 3 hours down to just 40 minutes. It boasts a punctuality rate of 99.9%. For the commuter and the economy on the ground, this is a game changer. It works. The trains run on time. The technology is sound. However, as investors, we don't buy engineering. We buy returns on invested capital. And this is where we have to define our first major concept for today: the cost overrun. The project was originally pitched in 2015 by President Joko Widodo. The pitch was incredibly attractive, a pragmatic deal where China would build the rail without government guarantees. The original budget was set at roughly $5.5 billion US. Fast forward to today, and that number has ballooned to over $7.3 billion US. That is not a rounding error. That is a nearly 33% increase in costs. So why did this happen? This brings us to the core of today's analysis: the governance gap. When we analyze a REIT or a conglomerate on the SGX, we often look at metrics like gearing or net property income. But for regional infrastructure, you have to look at execution efficiency. The cost explosion here wasn't caused by Beijing raising interest rates. It was caused by 3 specific domestic factors. First, land acquisition delays. This is the silent killer of returns in ASEAN infrastructure. You cannot build a train if you cannot buy the land. And the legal hurdles in Indonesia cause massive delays, which in turn spike construction costs. Second, poor interministerial coordination. You had different arms of the Indonesian government failing to align on permits and regulations, dragging the timeline out. Third, and most concerningly, alleged domestic markups. This has led to a probe by Indonesia's Corruption Eradication Commission, or KPK, into irregularities. This distinction is vital for us as Singaporean investors. The media loves the predatory China narrative because it fits a geopolitical story. But as investors, if you buy the China debt trap story, you are missing the actual risk. The failure of the Whoosh is a failure of Indonesian execution, not Chinese lending strategies. Why does this matter to your SGX portfolio? Because when you buy a share of a regional conglomerate or when you buy a Singapore bank that has significant exposure to ASEAN markets, you are not just buying their growth potential. You're underwriting their governance risks. If a state-backed mega project, which presumably has the highest level of scrutiny, can bleed cash due to internal inefficiency and potential corruption, it forces us to apply a significantly higher discount rate to any regional infrastructure play. We need to talk about the regional ripple effect. This is where we move from the specific project to the macro environment that affects your money. Singapore's direct exposure to this specific railway debt is minimal. Our banks are disciplined. However, the macro implications are significant for anyone holding a diversified portfolio. In its November 2024 Financial Stability Review, the Monetary Authority of Singapore, or MAS, flagged that emerging market vulnerabilities could trigger rapid capital outflows. When a major ASEAN economy like Indonesia faces a fiscal squeeze from mega projects like this, three things happen that directly impact the region. Number one is fiscal tightening. Let's define this. Money spent servicing debt is money not spent on productivity. Every rupiah that goes to paying off a cost overrun on a railway is a rupiah that is not spent on education, healthcare, or new roads that actually feed into the economy. This slows overall growth in Indonesia, which is the largest economy in Southeast Asia. If they sneeze, the region catches a cold. Number two is credit contagion. This is a psychological but very real market force. International institutional investors often do not look at countries individually. They look at baskets. They see emerging markets or ASEAN. If risk sentiment shifts because of a governance scandal in Jakarta, international capital tends to pull back from the entire region, not just the country involved. This can compress valuations for high-quality companies in neighboring markets simply by association. Number three is refinancing risk. Corporations with heavy Indonesian exposure may face higher borrowing costs. If the sovereign rating or the perception of risk worsens, the cost of debt goes up for everyone operating in that ecosystem. Now let's address the elephant in the room, the debt trap versus the governance trap. You will hear pundits say Indonesia is trapped by China. But looking at the latest reports, Indonesia is currently negotiating a financial reset with Chinese creditors. Interestingly, China has been flexible. They are discussing extended terms and interest rate adjustments. Beijing wants this project to succeed as a showcase for their technology. The problem isn't the lender. The problem is the borrower's internal coordination. Indonesia has a new sovereign wealth fund, Danantara, which is weighing its options. But at the same time, different ministers are giving conflicting statements to the press. One minister says the state will bail it out. Another says they won't. This uncertainty is what kills valuation. This is the alpha for today. Avoid the lazy growth at all costs trade in ASEAN. The whoosh proves that operational success, the fact that the train runs, does not equal investment success. The project loses money. When you are evaluating regional REITs or telcos for your own portfolio, do not just look at their revenue growth. You must look at their Capex discipline. If a company has a history of massive capital projects with strategic or political justifications rather than strict economic profit justifications, you need to stay away. I would rather hold a boring Singapore bank with disciplined book value growth than an exciting regional infrastructure play with a hole in its balance sheet. So, where does that leave us? Let's move to Iggy's assessment. We need to balance the ledger. What is working? The asset exists and performs. The connectivity is real. The balance sheet of the lender, China, is willing to negotiate to avoid a default. This is not a scenario where the asset is seized tomorrow. What is not working? The governance structure. The lack of unified messaging from the Indonesian government creates a risk premium. The occupancy and ticket prices are currently not covering the massive debt load, meaning this project will be a drag on the national budget for years. The valuation context. Currently, Indonesian equities and related infrastructure plays are trading at attractive multiples compared to historical averages. However, they are cheap for a reason. The governance discount is real. Until we see clarity on how this debt is restructured, that discount is justified. So here is the final recommendation. For existing unit holders or shareholders of companies with heavy exposure to Indonesian infrastructure, My view is to hold but verify. If you are holding the big three Singapore banks, DBS, UOB, OCBC, you are fine. Their balance sheets are fortresses and they have factored this risk in. But understand that their regional loan books are where the volatility will come from. Do not panic sell, but keep a very close eye on their non-performing loan ratios in the coming quarters. For new buyers looking to enter the ASEAN recovery trade, my advice is to wait. The risk reward isn't there yet. The Corruption Eradication Commission probe is the event to watch. If heads roll and genuine reform happens, Indonesia becomes a buy. If it turns out to be just political theatre, the risk premium stays high. I would wait for a price entry point where the governance risk is fully priced in, or until we see a concrete resolution from the new Danantara Sovereign Wealth Fund. Let's wrap this up with a clear call to action. The Whoosh isn't a tragedy of geopolitics. It's a tragedy of accounting. It serves as a stark reminder that in our region, execution risk is often the biggest threat to capital preservation. Don't let the shiny high-speed train distract you from the messy balance sheet. Stay boring, stay safe, and keep watching the governance scores. If you found this analysis valuable and want to go deeper into these regional trends without the fluff, consider becoming a free or paid subscriber to the Investing Iguana Substack. You will be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We are also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching. Keep your portfolio disciplined, and I'll see you in the next analysis.